Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to the week that was, the weekly podcast that sums up market movements and events from the past week along with their implications on asset markets. I'm Michelle Castellino, your host for this week's episode. The US and Iran reached a diplomatic breakthrough last week. While the interim deal does provide some optimism by potentially reopening the Strait of Hormuz and easing oil supply, it's important to remember that this is still a temporary arrangement. Even as supply begins to come back, it could take weeks or even months to normalize, especially with some of the infrastructure requiring longer repairs. At the same time, countries are likely to rebuild their reserves, which could keep demand supported. As a result, while oil prices may soften from the current levels, they are unlikely to return to pre-crisis levels in the near term. On the central bank front, it was a consequential week on both sides of the Pacific. The US Federal Reserve held rates steady at 3.5 to 3.75% in new chair Kevin Warsh's very first FOMC meeting. But the tone was far from dovish. Fed removed its previous easing bias entirely from its post-meeting policy statement, and the Fed dot plot showed 9 of 18 officials now expecting at least one rate hike before the end of 2026, pushing the median year-end rate projection up to 3.8%. Wall Street did not take this well. The S&P 500 fell about 1.2% and the Nasdaq dropped about 1.3% on the day of the decision, while Treasury yields climbed sharply as investors recalibrated their rate expectations. However, markets partially recovered the next day, with the S&P 500 bouncing back 1.15% and Nasdaq gaining about 1.5%, helped by the US-Iran peace deal and some cooling in oil prices. Meanwhile, the Bank of Japan raised its policy rates by 25 bips to 1%, its highest level since 1995, driven by persistent inflation pressures and yen weakness tied to the Middle East crisis. Importantly, the move was well telegraphed and largely priced in, so markets took it in stride. The Nikkei actually responded positively, climbing 1.8% to fresh record highs by Thursday. Now, coming to key India macro updates from last week. India has overhauled its WPI data and launched a new series with 2022-23 as the base year, replacing the old series which dates back to 2011. Under the new series, May WPI inflation came in at 9.68%, driven primarily by fuel and power inflation of close to 30%, tied directly to the Middle East energy shock. The new WPI series expands the coverage significantly from 697 items earlier to 957 items now. This also includes newer areas like renewable and nuclear energy, making the index more reflective of today's economy. India's trade deficit data also came in. Merchandise trade deficit widened to $28.2 billion in May 2026, up from $22.6 billion a year ago, as imports grew faster than exports. Exports rose 18.02% year-on-year to $45.2 billion, while imports grew about 20.6% to $73.4 billion. On the positive side, tax collections remain strong, with the net direct taxes growing 14.6% year-on-year and advanced taxes rising by about 15.3%, reflecting healthy income trends. On Forex, India's foreign exchange reserves fell by nearly $10 billion to $671.63 billion as of the week ended June 12th. This continues a trend of reserve drawdown as RBI has been actively selling dollars to defend the rupee, which has been under pressure from the high crude oil import costs and sustained FII outflows. The reserves had briefly recovered above $700 billion earlier in June before this pullback. Now turning to Indian markets, Indian equities had a broadly positive week right up until Friday. The Nifty and Sensex had strung together 5 consecutive sessions of gains through Thursday, supported by the easing crude prices and the positive global cues. However, Friday saw a reversal, with Nifty ending down 0.64% and the Sensex down 0.78% for the day, snapping that winning streak. Overall, Nifty and Sensex were up about 1.7% for the week. The sell-off was driven by a sharp fall in IT stocks after Accenture cut its annual revenue growth forecast to 3 to 4% from 3 to 5%, citing the West Asia crisis weighing on its consultancy business. The Nifty index crashed over 3% on Friday alone. Broader markets, however, held up well and actually outperformed large caps on Friday. The Nifty mid-cap settled 0.22% higher, and Nifty small-cap was up close to 0.4%. Broader markets also outperformed for the week, with the Nifty mid-cap index up 2.9%, while small-cap index was up 3.2%. Capital goods was the top gainer for the week, rising close to 6%. Realty and telecom index followed, up over 4% for the week. On the currency front, the rupee strengthened by 0.8% last week to 94.3, marking its best weekly performance in around 11 weeks, largely supported by a decline in crude oil prices. From a global perspective, the dollar index strengthened by 1.1% last week, reaching its highest level in a year, while US 2-year Treasury yields also moved higher. This came as Fed's latest policy signals reinforced expectations that monetary conditions are likely to remain tight going forward. India's 10-year G-Sec yield closed at 6.8% on Friday, declining by 7 basis points over the week and marking its fourth consecutive weekly fall. This was supported by softer oil prices following the peace deal, along with continued foreign inflows aided by the central bank's recent measures. Finally, a quick word on gold. INR gold was down around 1.9% for the week, though it remains a strong outperformer year to date at gains of over 9%, reflecting sustained safe haven demand through the geopolitical uncertainty of 2026. That's all for this week's edition of The Week That Was. If you found this useful, don't forget to like, share, and subscribe. Thanks for tuning in and have a great week ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.